Big banks kick off the third quarter earnings season. Goldman and JPMorgan seeing their quarterly profits boosted by a flurry of Wall Street deal making, but JPMorgan Chase CEO Jamie Dimon still highlighting significant risks persisting, including trade uncertainty and high fiscal deficits. Here to discuss this and more, we have HSBC Head of U.S. Financials Research, Saul Martinez. So great to see you as always. Let's start there. So with JPMorgan, because those comments from CEO Jamie Dimon certainly get attention, making some headlines. Mr. Dimon calling out weaker job market, inflation. I see JP Morgan, looks like they did report $3.4 billion of provisions for credit losses. Bloomberg noting, Saul, that was slightly higher, it looks like, than analysts had expected. You know, we know Jamie Dimon, he can tend to sound more cautious, but I'm just curious, what did you make of those comments? Does it affect in any way, Saul, as a financial analyst, how you think about the stock?
No, I mean, and thanks for having me. Look, I think, Jamie is pointing to what we are seeing already. I mean, just in the last few weeks, we had, the Tricolor debacle, First Brand, bankruptcy. CarMax had difficult results. So there has been greater concern in the market, and you actually seen it in the last couple of weeks in bank stock prices. Bank stock prices have been hit a little bit, and you've seen it in the alternative asset managers as well, who have been hit much harder. So there are these concerns about credit overall in the economy, and I think what Jamie is doing is he's pointing out that there are pockets where largely outside of the banking system, but there are pockets where there are where maybe folks got overextended, and there could be losses. And so he is pointing out something that there may be some fragilities that exist out there. That said, I mean, even in the case of JP Morgan, but in the results of Wells Fargo and CitiGroup, overall the credit performance was a relief, not something that's causing people to worry. And I think that's part of the reason you're seeing the stock prices react well. The commercial loan portfolios are performing reasonably well. Consumer portfolios are performing well. So thus far, the bank credit dynamics seem to be favorable, but certainly it's something you have to pay attention to, because we are seeing some pockets of weakness in the credit market, and that's something that Jamie pointed out this morning.
I'm just looking at JP Morgan stock here, so it is down about 2% in today's trade. What do you think explains that?
Look, it's interesting because one of the takeaways from this morning is just how divergent the stock price reactions have been. Overall, if you look at bank stock, not just those who reported today, but more broadly, they're reacting well to these results. I think in the case of JP Morgan and Goldman Sachs, it's a reflection of expectations. Expectations are high for JP Morgan. The stock trades at 2.9 times tangible book value and has done extraordinarily well. And I think there are a couple things to point out. These were good results, don't get me wrong, but net interest income, the guidance for the initial cut for the outlook for 2026, net interest income excluding markets, $95 billion, may have been a little bit soft relative to what some people were expecting. And they also highlighted that expenses for next year are likely going to be higher than what the consensus number is, which is about $100 billion. So given really high expectations and good results, but maybe some areas where the market was expecting a little bit more, that's a recipe for underperformance.
So about Wells Fargo too, so I want your take on that. Asset cap is removed. What did you make of that report and what's ahead? The CFO saying this is one of the best franchises in the country. Yeah. You agree with that?
For sure. I mean, it is, really. I mean, Wells Fargo, Bank of America, and JP Morgan are the three national banks. And Wells Fargo has been hamstrung by the asset cap, and the asset cap has been lifted. So, there are some opportunities to grow the balance sheet. I think, my diagnosis of JP Morgan, where expectations are high, I think the opposite could be said for Wells Fargo. I think there were some concerns coming into the quarter about whether they might have to lower their guidance for net interest income for the full year. The guidance is flat for the full year. And they reiterated that guidance and gave fourth quarter guidance for net interest income that was pretty strong, and that showed a sizable uptick versus the third quarter. But the underlying trends are good. Loan growth is getting better. Fee momentum has been good. And I think importantly, what they said was, they gave a medium-term guidance for returns on tangible common equity of 17 to 18%. They're kind of at the 14, 15% level. And so that I think was encouraging to folks because it did suggest that, management is confident that the trajectory for profitability is moving higher in the coming years.
You mentioned Goldman. I want to circle back on that one too, Saul, because that's another one down about
Yeah.
2% in today's trade. Is that just expectations, or were there questions about expenses as well?
I mean, there could be some, questions about certain things in the results. Overall, the results were good. Now, we have a reduced rating on Goldman and on JPMorgan because our view is that we're really pricing in a lot, and there's a really high hurdle to get over for these stocks to outperform over an extended period of time. And I think the results for Goldman and JPMorgan sort of reflect that today. These were good results. These were, really good. Investment banking up 42% year on year. Sales and trading was up low double digits. You did, if you wanted to nitpick anything, the equities sales and trading was not as strong as I think what was expected. There was a little bit of cost pressure, but they still did positive operating leverage. I think really with Goldman is the expectations, given the resurgence in capital markets activity is really high, and it's to meet that hurdle is more challenging. You really have to believe in the case of Goldman, in my view, that consensus earnings expectations and my earnings expectations are too low if you want to get upside. And these results were good, but they didn't change the narrative per se. And I think the soft stock price reaction is a reflection of that.
So you have a reduce on JPMorgan, Saul. We got a reduce on Goldman. You have a buy on Citi, right? So let's talk about that, because that one's in the green today. Looks like they beat the street's revenue estimates across all 5 of the major business lines. Total revenue looks like jumped 9%. What do you make of that report?
They were really strong results. I think the story for Citi is that they are on the right track in terms of getting profitability, returns on tangible common equity, higher over the next few years, and that will allow for price to tangible book value multiple expansion. They trade at only 1 times tangible. And I think the results really showed that. They had showed really good momentum across businesses, positive operating leverage across all the business segments. I think Jane Fraser and the management team are doing a good job of really improving business performance. The outlook there for next year, I think, is a positive one. We expect revenue growth. They expect revenue growth. The cost there are multiple levers they can pull on cost. So there's good line of sight on operating leverage. There's capital flexibility. They bought back $5 billion of stock so they can rationalize the capital base, and they're buying back stock at tangible book value, not 2 and 3 times tangible book value. So that's a plus. So it's just another. I think for CitiGroup, it's about management building credibility because they have disappointed so much in the past. That if they continue to deliver quarter after quarter towards driving up higher ROTCEs, they climb that wall of worry, and the multiple expands over time, even as they grow their book value per share. So I think this is a stock that has some legs and can really outperform for some time.
So always great to see you. Thank you.
Likewise.
Brooke, you've been looking at all the big bank players. What stood out from to you from those results?
Allie, those record highs back throughout this third quarter really stood out to me as the momentum behind most of these key earnings reports. CitiGroup, JPMorgan, and BlackRock pointing out record or best market revenue that they've seen in quite some time. CitiGroup saw market revenue for the third quarter grow by 15%. We also have JPMorgan seeing their market revenue grow about 25%. And BlackRock noted a record quarter for iShares ETF alongside private markets and cash net flows. lows. And I think it's worth pointing out that this is a market that we've been covering over the past, few months that has been truly resilient, has really pushed through with this AI rally. And now we're really hearing from these banks the influx of investors looking to get in on this rally that we've seen so far. And that's what really stood out to me this quarter. I also do want to point out Wells Fargo, because that stock moving higher this morning, despite the slowdown that we're seeing, or rather the laggards that we're seeing from the other big banks. And that's because of that strong loan business that they have. They're the fourth largest lender here in the U.S. And that momentum is certainly something I'm keeping an eye on, especially in this environment where consumers are seeking out or perhaps returning to bigger ticket projects. They're also, maybe looking to cash in, or rather, be able to use credit cards within this environment amid this uncertainty as well.
And JPMorgan CEO Jamie Dimon, speaking on the call, his comments are always closely scrutinized, but he said the economy remains resilient, but also warned about tariffs, deficits, worsening geopolitical conditions, and high asset prices. And Michael, that really captures the tension that we've been seeing. And I'm curious, from your perspective as a strategist, how do you make sense of that dynamic?
Well, there is a lot of exuberance in this tape. There's massive retail engagement. Definitely at the strongest level since 2021 during the meme stock frenzy. Could be the strongest retail engagement ever. So that's what the summer has been. And that also obviously feeds into the rich valuations out there and those risk factors. And I think what you're seeing in Jamie Dimon's comments, where he does tend to be cautious, because, when the U.S. supertanker reverses course, it's slow. It's hard to get it back on course. And what you're seeing is these little slowdowns, whether it's a job market slowing, that slowdown's been going on over the summer, whether it's auto delinquencies rising. And now we're looking at a situation where we have a government shutdown. So we really don't have data, we don't have the traditional government data to go on as far as formulating policy going forward. So I think those are the risks that are in tension with these high valuations we have out there.
And Michael, Brooke was just talking about the loans business for Wells Fargo, and consistently you're hearing from these banks that their customer base remains strong and resilient. However, a lot of those customers are those high-income consumers, and we still have a very bifurcated landscape. So what's the economic risk if we have one cohort of consumers, those higher earners, really propping up the broader economy?
So, it's very similar to what we see in the stock market. We have a very narrow leadership group in the economy. This has been going on for some time, though. Like if you look at the dollar stores, or even when Walmart has reported earnings in recent quarters, and Target, they've talked about lower income consumers feeling stressed, but they talk about their consumers being value seeking. And that has been a trend that's probably been going on for more than a year now. And when you look at the stock market today, we see it's very top heavy, and the Magnificent Seven names they're driving earnings, and they're driving performance in the index. And you're seeing other stocks be left behind, or they're definitely not getting the valuation premiums those mega cap names are. And so you just have this narrow cohort leading the stock market, and you have a narrow cohort of consumers driving the economy.
And Brooke, Michael was just talking about consumers seeking out that value. You've been reporting on this for quite a bit of time now. What have we learned so far about that movement? And what are strategists saying when it comes to the rest of earnings season and some of those key consumer staples that we'll report?
Yeah, well, certainly all eyes will be on those companies that have outperformed this environment. We truly have this bifurcation, as you had noted, between that high-income consumer really holding up the momentum and Walmart really seeing a gain across all income cohorts. What we expect to hear for the rest of this earnings season, and what we have already heard from companies like Delta and PepsiCo, United, set to come out this week as well. What we've heard, though, is that once again, this high-income consumer really willing to splurge on this premium experience like at Delta. Then you have PepsiCo saying that low-end consumer is really looking for affordability, that they're stretched by inflation. And then when you look out, we expect to see, this is a key season for those retailers. This is the big holiday season. And yet what I'm hearing from so many sources is that consumers are really heading into this next few months really stretched. They're really budget focused and really value oriented. And so all retailers and all companies really have have to lean into this consumer that is, really stretched by that higher inflation that we're seeing right now. Despite the fact that most tariffs, haven't even been passed on yet, Goldman Sachs was out with a report on Monday saying that by year end, about 55% of the tariff impact will be passed along to consumers. So we'll have to wait to see more of that.
As you just heard, we were talking about, kind of the economic backdrop, also the stock action and what we've seen from these banks. Did what you hear from them this morning, by and large, validate your view that the valuations are justified?
Yeah, hi, Julie. I think so. Yeah, this was certainly a banner quarter for the banks so far. We're only one day into the earnings cycle, obviously, but the upsides are pretty considerable. Particularly the capital markets. We expected the lending businesses to be, a little bit weak, kind of this low single-digit loan growth, but capital markets really did shine this quarter, and I think that's, part of the justification for the price performance so far is that those rebounding capital markets, and it's really across the board. IPO activity, it's M&A, it's the trading results, fixed income issuance. So there's really no weakness that we're finding, and the conversations from the banks has been constructive as well. So this is a spooling effect generally. Good results tend to portend more good results because whether it's IPO activity, if a company comes out, goes public and does well, it attracts others into it. And we think there's a fair amount of pent-up demand for companies to go public or even take private. We had some of those like Electronic Arts in the quarter. And keep in mind that the deals, even though M&A deal flow topped $1 trillion in the third quarter, banks don't see that revenue right away. It takes a couple of 3 quarters for those deals to close, for the transaction to take place in order for them to get paid for those deals. So that means, looking out a couple of quarters, we would continue to expect that revenues will still be very healthy.
What do you make of some of these bubbling concerns about credit and about private credit and lending? We just heard Dave talk about JPMorgan disclosing something they didn't need to disclose, but they did perhaps because they know there's some sensitivity around the issue right here. Do you think there are vulnerabilities among the larger banks to some of these loans?
Well, I would look back, even a couple of years. We've been talking about the commercial real estate broadly as being a worry spot for banks, and it hasn't occurred. They've been able to either refinance or some of these loans or get extensions, or interest rates, moving down a little bit has been beneficial for some of these, and that's a kind of a counter to this theme of potentially worsening credit quality. Anytime you have lower rates, it just makes it easier to refinance and a lower payment. So on average, these companies will be able to avoid defaults for the most part. So yeah, I think there's weakness in auto loans and in credit cards, despite now JPMorgan has a stellar credit card portfolio, and they were able to reduce actually their expectations for charge-offs this year. But we're looking at this employment environment getting a little bit more soft. Unemployment hasn't ticked up noticeably. That's one of the biggest factors to look at in terms of higher defaults. If unemployment moves up even a couple of tenths, you will see that in bank charge-offs and thus loss provisions. So right now, the commentary from banks is still benign. The consumer's in relatively good shape. Resilient consumer is what they have been referring to for the last several quarters.
So, Stephen, would you say to investors who see JPMorgan and Goldman Sachs going down today that this is an opportunity to pick up some of those shares?
Yes, I think that so expectations were built throughout the quarter that it was going to be a pretty good capital markets quarter. So I think some of that is taking some off the table. I didn't find anything particularly that the banks talked about in terms of guidance so far that was worrisome. Whether you look at the capital markets commentary and how constructive that is, or the commentary about credit quality. Loan growth has been weak, and that's kind of that low single digit, and we don't see that noticeably improving. The Fed rate cut that occurred was too late in the quarter really to have any kind of impact going forward. It could, and future rate cuts may stimulate loan growth a little bit, so that's still out there. But I think the performance narrative that we've had so far this year, the outperformance of banks relative to the market, whether it's a constructive interest rate environment, a little bit steeper yield curve for banks, now some lower interest rates that could benefit the lending growth, this capital markets rebound, which I think is just showing itself to be much more durable, and then this wild card of capital regulation, or just regulation in general, and capital requirements that could be eased a little bit for banks is also a catalyst. So they've got a fair amount of tailwinds here, I think.
Brooke, just like we did yesterday, going to start today with bank earnings, and the themes are feeling pretty similar here.
Yeah, pretty similar indeed. Deal making, that rise that we saw in the equity markets to record highs, and all those mergers and IPOs that we saw in the third quarter really contributed to both Bank of America and Morgan Stanley's strong earnings report that beats Wall Street's expectations. And that's why you see both stocks moving higher in this pre-market hours just this morning. Taking a deeper look into Bank of America specifically, what we saw there was their investment banking, or those deal making fees. We saw those increase by about 43% from a year ago to $2 billion. Now, keep in mind, during this past quarter, Bank of America played a large role in that Union Pacific agreement to purchase North Fork Suffolk. So that really contributed to that portion of the business as well. In addition to that, we did have client trading rise about 8% to $5.3 billion, really showing this willingness of investors to get in on this market and the activity that Bank of America saw. And it was a similar story over at Morgan Stanley. Taking a closer look at those numbers as well. Investment banking fees, once again, those deal making fees, those were up about 45% to $2.1 billion. Now, they also advised on that deal that we've been covering quite closely of Keurig Dr. Pepper to acquire JD Peet's, a Dutch company as well, the Dutch coffee company. Also, in addition to that, we did see trading revenue from Morgan Stanley that was up about 24.5% to $6.2 billion. And that's combined equity, fixed income, also currencies, as well as commodity trading. But specifically within the equity trading revenue, that increased 35%. And so really, both of these earnings reports really fueled by this record high rally that we've seen, and also this deal making environment that has largely returned after a bit of a slowdown earlier this year.
Bank of America and Morgan Stanley reporting stronger than expected third quarter results, boosted by a surge in deal making on Wall Street. Joining me now, our banking reporter David Holler. So, Dave, really this seems to be continuing what we heard yesterday from the big banks as well. What stands out from these two?
Yeah, exactly, Julie. And yeah, just to take a step back, it is kind of interesting. There's a natural tension going on because the big banks are riding pretty high right now. And for Bank of America and Morgan Stanley, which came out with results this morning, what stands out is that they both sort of have their own places of strength. Morgan Stanley's equity underwriting business that does IPOs had a record quarter. Bank of America had set a record for its lending margin, its net interest income. And if you go back to yesterday, there were also a lot of records from the other banks too. Just to go through a few, Goldman Sachs has, over the third quarter, actually crossed the $1 trillion mark in terms of the amount of M&A volume it's advised on so far year to date. It's ahead of peers on the league tables as far as that's concerned. Wells Fargo also increased a key profitability measure, and JPMorgan Chase is on pace with yesterday's results, depending on how the fourth quarter goes, to set another history for profits in banking history. So we have a lot going on here, and across the board, it looks good and better than what analysts had anticipated.
It seems like, I mean, the stocks were a little bit mixed yesterday, but it seems like by and large that these results have been looking good. You just heard some of the trends that David Hollerith was talking about. What do you think of their sustainability now going forward?
Well, I think the issue, as David pointed out, I think it was a great quarter. Wall Street was great. Loan demand was decent. Spreads were a little better. Credit remains very good. So it's like, okay, so what's going to get better from here? It's the old stock market. If there's nothing to get better, then there's nothing to talk about. And I think that's going to be a struggle for a while until we understand where the economy is headed in a bigger sense. But I think what this quarter tells you is that generally the economy as a whole is in good shape. The banks are growing loans faster than they've grown in a long time. Margins are a little better. Credit obviously is a big thing that everybody worries about, and it looks like the banks are, building reserves if they need to, but the credit trends are just not that negative, even though people worry about auto delinquencies and a few other things that are popping up. So I think this bodes well for the rest of the earnings season, not just the banks, but all of the other companies.
Let's pull on that credit thread a little bit more, David, because yesterday, of course, JPMorgan mentioned Tricolor. We know First Brands, that auto parts company, also running into some trouble on the credit front. How are you thinking about, as you said, it doesn't look like right now that it's creating a big negative ripple effect, but what are you watching? How are you thinking about it to try to assess the risk there?
Well, I think it's sort of, that's why you come to work every day and watch the economy and see what's happening. I think generally the banks are just a lot more willing to say, you know what, I'm going to write it off and move on. I'm not going to try to hang on to it. I'm not going to try to reset it or renegotiate it. And the banks have the profitability to do that. And they haven't historically had that. So I think you've got an industry that says, look, credit card delinquencies are rising. We're just going to cut it off. We're going to write it off and move on. So they're not going to let the bad stuff build up in the system, which is historically what they used to do. So I think you've got a banking industry that has a much more get rid of the stuff, move on. Let's not try to, have all the stuff build up in the system and then blow up all at once. So I think it's a much more disciplined system. People have been worried about credit for a decade. Jamie Dimon and myself are roughly the same age. We both went through 2008. We know what that can do. Nobody wants that again. And so I just don't think we're going to have it, at least in the banking industry.
Yeah, definitely not something that that we would repeat, hopefully, although usually these crises unfold in a little bit of a different flavor, but hopefully we won't repeat any of it. David, as you look across the largest banks here, which we've now all heard from all of them at this point, would you own all of them? Are there any that you think are less attractive or more attractive within that universe?
Well, I think on valuation, Citicorp is clearly the cheapest. Citicorp and JPMorgan roughly have the same book value. And one is at 100 and one's at 300. So just from a valuation perspective, Citicorp has a way to go. Of course, they're not earning as much and have had issues, over the years, but it seems like they're getting their footing. And if you want to own something for the next couple of years and watch it improve from a low base of earnings from respective return on equity and assets, that's the one to own. But I think you can own all of them, all of the big four, the big five. They have the profitability to invest in the business. We haven't really talked about AI yet, but Goldman Sachs was interesting yesterday saying that they're using AI to reduce expenses or reduce headcount. So that's an interesting comment to make when you're doing so well. And if they're doing it, everybody else is going to do it. So if you look at the industry, the profitability of this industry has not changed in 40 years. The return on assets and the return on equity are roughly the same as they were 40 years ago in terms of the high performers. And so if we can get a break from that, either using M&A, using deregulation, using AI, or whatever else you want to use to break out of that and have higher returns over the next couple decades, then the stocks can really move. And that's what I think is the big opportunity, is to break out of this historical range of profitability, and hopefully that will show up in the stock prices.
Yeah, that's a really interesting development. I mean, it applies to a lot of industries, but it'll be really fascinating to see how it applies to financials. David, great to catch up with you. Thank you.
Yeah, you're welcome.
While the banking giants became the latest to benefit from a Wall Street deal-making boom, looking beyond the frenzy of mergers and IPOs, there's caution to consider. Joining us to discuss this and more, we got Christopher McGrady, KBW Managing Director and Head of U.S. Bank Research. Chris, it is great to see you. Maybe start there, Chris, with these auto industry bankruptcies, First Brands, Tricolor. I'm just curious, as an analyst, covers this space. Walk me through how just you're thinking through it and possible ripple effects.
Well, hey, Josh, good to see you again. The credit stuff is something we're paying attention to. Two large, prominent bankruptcies in a short period of time. We're getting more questions on credit. I wouldn't say we were complacent on credit, but this is a not so gentle reminder. But if you take a step back, right, we're coming off a period where credit costs for the industry are at multi-decade lows. So this is, I would say, part of the normalization process. It's a pretty severe reminder. But overall, if you think about the bank's balance sheets, they're in a pretty great spot, right? They got a lot of capital, a lot of reserves. But again, this is something we're watching as we go through the quarter.
Some names in your coverage list, Chris, they reported this morning. I want your take on it. Morgan Stanley, solid. Investors like what they see there. Investment banking was up 44%. Looks like trading was up 35%. What do you make of the report as a fan of the name?
Right, Morgan Stanley is one of our top ideas, but broadly, the biggest banks, JPMorgan, Bank of America, Morgan Stanley, Goldman, the results have been excellent, right? You've seen a rebound in capital markets. All the banks gave updates about a month ago. They've all exceeded expectations for investment banking and for trading. There's pent-up demand, as you're hearing on these conference calls, for activity. And so while there's always an element of uncertainty in the macro, companies are getting more visibility and they're willing to transact. So the results are great. You take a step back and also think about the returns these banks are generating and our view on the banks broadly. We have this triple crown theme at KBW where scale, consistency, and deregulation are really winning. It's case in point. We're seeing it play out in real time with these largest banks. The ROEs are tremendous. They're high teens, if not 20% plus. And so there's really a lot of momentum going on.
Just more broadly on the M&A environment, Chris, I'm curious, if the Fed is going to be cutting, what does that mean for the environment now and ahead for deal making?
I think CEO confidence is really important to underwrite a deal, right? We're seeing CEO confidence move in the right directions. Part of that's the wealth effect with asset prices inflating, but there is a pent-up demand for activity, and I'll take the banks specifically, right? There's still 4,000 banks. And we're in this window of deregulation, right? The Trump administration has told us they're going to be more friendly towards regulation. And we're seeing it play out. We've seen several large deals consummate this year. I think there's probably expectations that we have a 12 to 24 month window before the potential change in administration kicks in. And so banks are willing to transact.
Let's talk about Bank of America, too. They reported as well this morning. Another name you like, Chris, also in the green. It looks like they beat estimates. That was a 43% jump in investment banking revenue. That's a standout. What did you make of that report?
Bank of America had, that's another stock we really like. The 15.5% return on equity. That's pretty significant. They've got a really important investor day coming up on November 5th. We think, like Wells Fargo did yesterday, we think they're going to paint a picture towards higher returns that are more durable. And so, Bank of America's results were really strong across the board. They had the capital markets, Josh, that you talked about. They also had organic loan growth, which is one of the pieces that investors are really pushing for this story.
What about Citizens Financial, Chris? I'm curious what you made of those results. Investors didn't look too wowed by it. You see the stock here. We're trading down about 1%. Was there disappointment in that report?
No disappointment. I would say it was a well-liked story. So a little bit of a crowding factor, technically. Investors like the story, right? Our thesis is really they're in the process of a multi-year ROE improvement story. So you're going from a low double-digit to a mid-teens to high teens ROE over the next couple of years. What I thought was really interesting on today's call with Citizens is they said the 16 to 18% ROE target that they have for the medium term, that's on track. But they're also not satisfied. They're going back to the well. They're trying to find additional synergies in the business as they grow. And so there's on top of that potential ROE improvement. Again, we're talking multiple years, but I think the stock reaction is just Nothing in the report itself, just a bit of a positioning dynamic.
Final question, Chris, as you look through these reports, you listen to conference calls, what would be kind of the read-throughs you would have about what it says about the macro, what it says about the consumer?
I would say broadly take the two credits that we talked about out. The consumer's in pretty great spot. Commercial credit's been very good. There's been a lot of questions about economic assumptions and the outlooks, and most of the banks are pretty confident. So we're of the view that we're in a normalization process with credit normalizing higher, but at a very reasonable to a reasonable degree. And so there's reasons for optimism going into 26.
Chris, great to see you. Appreciate your time and those picks.
Great. Thanks, Josh.